Have you ever wondered how huge companies or even, your local coffee shop manage to protect themselves from just wild price swings? Well, today we're going to dive into two really powerful financial tools that are designed to do exactly that: futures and forward contracts.
I mean, we all are, right? In some way, whether you're thinking about the price of gas, what you're paying for groceries, or the raw materials for a business. That uncertainty about future costs, it can be pretty stressful. So, what if you could just lock in a price today for something you need months from now?
To make this whole thing crystal clear, let's just tell a simple story. We're going to follow two people whose entire livelihoods depend on the price of one thing: wheat. So on one side, we've got our farmer, and on the other side, we've got our baker.
Now, they have completely opposite problems. The farmer, she's got a whole crop that's going to be ready to sell in about 3 months, and she's terrified the price is going to crash, completely wiping out her profit. Meanwhile, the baker, he needs to buy that wheat, and he's worried the price is going to spike, making his bread way too expensive to produce. They both desperately need some price certainty.
So what's the absolute simplest solution here? Well, they could just make a direct agreement between themselves. A good old-fashioned handshake deal.
So imagine the farmer and the baker meet up. The farmer says, look, in 3 months, I'll sell you 1,000 bushels of my wheat for exactly $7 a bushel, and I don't care what the market price is then. The baker says, deal. And just like that, problem solved. Or is it?
This little handshake deal they just made, it actually has a formal name. It's called a forward contract. And what that means is it's a completely private agreement, and it's tailored specifically to exactly what they need.
So this is the crucial part. Everything about this deal is totally up to them. It's private, nobody else is involved. It's customized for the exact amount of wheat the baker needs on that specific day, and because it's just between the two of them, it's completely unregulated.
And here is the catch. What happens if the market price for wheat just skyrockets to $10? The farmer might be really, really tempted to just break her promise to the baker and sell on the open market for a way bigger profit. Or what if the price crashes down to $4? The baker might be tempted to just disappear. This is the big risk right here.
Okay, so to solve that big problem of trust, our farmer and our baker could turn to a more structured, more formal marketplace to make their agreement.
Think of it this way. They're moving from a private, backroom deal to something more like a public stock exchange. This marketplace, it acts as a trusted middleman, and its whole job is to make sure that everybody plays by the rules.
And this more formal agreement is called a futures contract. The two key words you got to remember here are standardized and traded on an exchange. This is not some custom handshake deal. It's more like a generic, off-the-shelf product that anyone can buy or sell. So unlike that forward contract, a futures contract is public. The terms are all standardized. For instance, one contract might always be for 5,000 bushels of a very specific grade of wheat. And most importantly, it's regulated by the exchange, which guarantees that the deal will absolutely be honored.
Okay, let's put these two side by side. I really want to nail down the differences so they're super clear.
Really, at its heart, the difference is pretty simple. A forward is that private, custom handshake deal. A future is a public, standardized marketplace product.
And this table just lays it all out, right? Forwards are private, they're totally customizable. But that flexibility comes with a high counterparty risk. That's the risk the other person just won't pay up. Futures, on the other hand, are standardized and regulated, which means, yeah, you lose that flexibility, but the exchange guarantees the contract, which practically eliminates that counterparty risk. So why does any of this matter to you if you're not a farmer or a baker? Well, it turns out these contracts are really used in two main ways. You can be a hedger or you can be a speculator. See, hedging is all about reducing a risk you already have. Speculating, that's about taking on new risk because you're hoping to make a profit. Our farmer and our baker, they were totally hedging. They weren't trying to get rich quick. They were just trying to protect their businesses from those unpredictable price changes. They were managing their risk. And this illustrates the goal of a hedger perfectly. It doesn't matter if the market price of wheat goes up, down, or sideways. They have locked in their price. Now, sure, they might miss out on a massive windfall if prices shoot up, but they're also totally protected from a disastrous loss. Their profit becomes stable and, most importantly, predictable. A speculator, on the other hand, has zero connection to the actual wheat. They've probably never even seen a farm or a bakery. They might buy a futures contract simply hoping the price of wheat will rise, which would let them sell that contract for a profit without ever touching a single grain.
And this really just sums it all up, doesn't it? The farmer and the baker, they're trying to manage their risk. A speculator sees that risk, takes the other side of that bet, and sees it as an opportunity for profit.
And that's really the fundamental question these tools force us all to ask. Are you using them to protect a business you already have, like a hedger, or are you using them to place a bet on the future, like a speculator? Understanding that one difference, that is the key to mastering tomorrow's price today.